Hello, and welcome to episode 126 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. I am Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Hey, Mark. Well, the Fed cut rates again.
Indeed, they did, Odeta, and that was almost exactly, or probably within a couple of days of exactly a year ago. So Here we go. They're trying to bring rates back down to earth. Get it? Get it?
Yeah, that's Carly Simon, technically late 80s, but we can round up to count this as your obligatory 80s reference for this episode.
Technically late 70s. Late 70s.
Oh, did I say late 80s? Late yes. 70s. Yeah, late 80s would definitely still count.
And you're more likely to know that one, right? So we're going late 70s, but yes, give it to me this time. But who said I'm done with my references? We're still early in this episode.
Yeah, I'm cringing at that prospect, actually, but we will digress to the topic of today's episode. Today, we're diving into a question that's been on a lot of minds, including our own. If inflation hangs around 3% or maybe even climbs, and the Fed keeps cutting rates, what does that mean for mortgage rates, housing, and even commercial real estate? Because the assumption that's out there is seemingly pretty simple. The Fed cuts rates, mortgage rates fall, housing booms. But as we'll explain, it's not exactly that straightforward. In fact, the yield curve might have something to say about that.
That's right. And, the last 30 or 40 years of housing, real estate, mortgage rate history, that was true. And so the question is, why is it not true anymore? And a lot of it has to do with the yield curve, which is the line, or in this case, the curve, that graphs Treasury bond yields, that is the interest rate that investors are requiring in return for buying those Treasury bonds, across different maturities. This has been the star of the show lately. And spoiler alert, it is steepening. That's a big deal for mortgage rates. The difference between the 30-year Treasury bond and the 2-year Treasury bond is close to the widest it has been since 2022. And even though the Fed cut rates by 0.25%, which reduced short-term yields, investors worrying about long-term inflation, among other things, the 30-year Treasury yield actually increased after the Fed rate cut.
Steepening indeed. So let's talk about that inflation. The latest data shows headline CPI at about 2.9% year over year, core CPI at 3.1%. The Fed's preferred measure, the core PCE, is also hovering near 2.9%. So we're not at that Fed target of 2%, but we're also not at 6% either, which is where we were a couple years ago. So we're in the sticky 3% inflation zone. At the same time, the labor market is cooling and the Fed is increasingly concerned about that. The August jobs data continues to show that the labor market is losing momentum. We gained just 22,000 jobs, which was far below the consensus of 75,000. And then there were downward revisions for June and July and a rising unemployment rate to 4.3%. It's also important to note that the job gains were narrowly concentrated in healthcare and hospitality, while we saw that goods-producing sectors actually posted losses. So this is a labor market really being driven by a few sectors. We also saw permanent layoffs increasing, so it's harder for job losers to find open positions. All things that the Fed is monitoring to make sure we're not headed towards a job loss recession.
First of all, Odeta, that was a phenomenal summary of the labor market in the economy today. That was very, very good. But, Debbie downturn arriving early in this episode.
I knew you were going to say that, and I felt it as I was saying and throwing all these stats at you. But, they don't call it the dismal science for nothing.
That is very true. But for a little historical context and maybe a silver lining to Debbie downturn here, even though the unemployment rate has increased to 4.3%, it is still low and actually very close to the Fed's full employment goal. The Fed just made its first rate cut of the year, 25 basis points, and signaled 2 more cuts before year-end in its dot plot projections to stave off further and more significant deterioration in the market, hopefully. The target range is now between 4% and 4.25%, but here's the kicker. They're still running quantitative tightening. We often forget about that, letting treasuries and mortgage-backed securities roll off their balance sheets. So they're easing on the proverbial short end of the yield curve, but continuing to tighten ever so modestly with QT, as it's called, on the other.
Hence the yield curve steepening. When the Fed cuts, the short end of the curve, think 2-year Treasury, moves down. But the long end, like the 10-year and the 30-year, they don't always follow. In fact, the 10-year is still around 4.1%, 30-year closer to 4.7%, the 2-year is at 3.5%. You can see all of these on Fred, by the way. It's kind of fun to pull up these series and see what they're doing. But we are still seeing a steeper yield curve.
I'm reminded of the graphic that we used to make where we would put it in 3D, the 3D yield curve graphic, right?
Yield curve. I'm gonna go ahead and promise that we'll attach that to the episode. We'll put that graphic in there somewhere, whether it's on our Twitter feeds when we publish the episode, but that's a good graphic.
Listeners, we're totally making it up on the fly right here.
Yeah, exactly.
And the reason for all of this is the term premium, the extra compensation that investors demand for holding longer-term bonds, especially because inflation remains elevated. So even as the Fed lowers short-term rates, the long end stays sticky.
And that matters because, as we know, mortgage rates are tied to the long end of the yield curve, specifically that 10-year Treasury yield. The latest Freddie Mac survey from the week ending September 18th puts the 30-year fixed rate mortgage at 6.26%. And I am going to mention two significant digits because that's a big deal, us approaching that 6.2.
Is there even a third possible? I guess there is actually, right?
Well, that is an action item for me to look into that. That's, down from 8% highs of 2023, but still pretty far from those 3% days.
And so here's the mythbuster. Fed cuts don't automatically translate into lower mortgage rates. As you just mentioned, mortgage rates follow the 10-year Treasury yield plus the mortgage-backed security spreads, not the Fed funds rate directly. So if the 10-year yield stays elevated, mortgage rates don't necessarily fall very much. Long-term rates are driven by two things: expectations of future short-term rates and the term premium. The Fed can influence expectations, but the term premium, now that's a different animal.
And that's where duration comes in. Long-term bonds have higher duration, which means their prices and yields are more sensitive to changes in expected future rates over the entire horizon. If markets think the Fed will cut a little and then stop, the long end doesn't move much. And in a positive term premium, you've got a sticky 10-year yield, even as the Fed lowers the short end.
Exactly. So the short end reacts quickly because it's tied directly to the policy rate, but that long end, it's like steering a cruise ship. It takes a lot more to move it.
That was a good imagery, actually, which means if you're waiting for a 5 handle on mortgage rates just because the Fed is cutting, unfortunately, you might be waiting a while.
Exactly. And the spreads matter too. The Fed is still letting mortgage-backed securities roll off their balance sheet, which keeps those mortgage spreads wider than they would be otherwise. So even if the 10-year does drift lower, mortgage rates might not fully reflect that right away.
Right. I mean, we've talked about this in the past, that the Fed being a buyer of MBS is one reason that spread was narrower. No longer a buyer, less demand for MBS.
Part of why we had a 3% or less than 3% mortgage.
That's right. Though I will say, silver lining, and to, not be Debbie Downer for just a moment here, there has been progress made on that spread. Still not back to the historical average of 1.7 to 2%, but also not above 3% as it was in 2023. The spread has come down to about 2.3 percentage points. This spread functions as a proxy for lender risk appetite, market volatility, and expectations about how quickly mortgages will be paid off. So it typically widens during periods of economic uncertainty, pushing mortgage rates higher even when the 10-year Treasury yields fall. But in recent months, the spread has steadily declined as the high economic uncertainty in the spring has subsided, and the expectation that recently originated mortgages at slightly higher interest rates will be refinanced, helping to ease borrowing costs without any direct action from the Fed. But let's talk about what this all means for housing. Even small declines in rates can have an impact on a very interest rate sensitive sector such as housing. We've already seen purchase applications increase as rates have moved closer to 6%, and existing home sales in July rose a little bit to 4.01 million, though came back down in August to 4 million. But that was the first improvement in some time. New home sales also increased in August to the fastest pace since early 2022. So there's been some response to lower rates.
I see a very positive theme here: improvement regardless of rates. And while builder sentiment remains in the doldrums, one component of that sentiment index is future sales expectations, which increased slightly in September. Inventory is also growing, though that growth is now slowing. And so even if mortgage rates only drift lower by a little bit, we could see sales still grind slowly higher through the end of the year.
And let's not forget adjustable rate mortgages, because we mentioned earlier that a five handle is unrealistic, but that's for a fixed rate mortgage. ARMs are tied to short term benchmarks like SOFR, so they respond more directly to Fed cuts. That means borrowers considering adjustable rate mortgages or ARMs might see faster relief than those sticking with a 30-year fixed rate mortgage. In fact, in the MBA mortgage applications data for the week ending September 12th, the ARM share of applications increased to about 13%. This is the highest share since 2008. The average contract interest rate for a 5-in-1 ARM actually decreased to 5.65%. So again, a five handle for those taking out an ARM.
Let's remember, I do believe we did a podcast episode on this long ago, that this is not the adjustable rate mortgage of the global financial crisis. This is the bread and butter safe adjustable mortgage, and it makes perfect sense that that share is increasing. And indeed, nice to see a 5 at the front instead of a 6. But all that talk of adjustable rate mortgages brings us to commercial real estate, because floating rate loans are common there. Lower short-term rates immediately reduce debt service costs for borrowers with floating rate debt, and that's a big deal for sectors like multifamily and construction loans, where financing costs have been a pain point recently.
So while the long end staying high limits how much cap rates might compress, the short end coming down provides breathing room for borrowers. So it's not a full recovery story, but it's a start.
Okay, so let's play out two different scenarios, Odeta. You ready?
I'm ready.
Scenario 1, the Fed delivers 2 more rate cuts, as they themselves are saying they will do this year. Short rates fall further, but there's still some inflationary pressure. The curve steepens and the 10-year maybe drifts toward 4%. Mortgage rates could move into the low sixes. That's enough to encourage some marginal buyers off the sidelines and improve sales, but not enough to spark a huge refinancing boom. We've mentioned this stat before, but don't forget that 81% of mortgage homes have a rate below 6% right now. And in fact, the average mortgage rate on all outstanding debt is only 4.1% at the moment.
So, scenario 2, Debbie downturn here again. The Fed pauses after this cut, short rates stabilize, the curve stays steep, and mortgage rates continue to hover in the mid sixes. Housing still improves from low levels, but maybe the pace is a little bit slower.
See, there's the kicker. Even if you're Debbie downturn in that rate scenario, we think sales will rise from the trough either way.
That's right.
The biggest affordability shock was going from 3% to 7% in a short period of time. That hurt. Coming back to the mid sixes makes a difference, especially with more inventory, but it's not going to be about rates.
That's right. And for buyers, timing the absolute bottom on rates is tough. If affordability works at 6.3%, waiting for 5.9% might mean missing out on the right home.
That's exactly right. And for sellers, even a small drop in rates can bring more buyers into the market, so the housing market doesn't need a 5% mortgage rate to thaw. It just needs stability and a little bit of relief. But more importantly, what I hope you get from this episode is that Fed rate cuts are not a panacea for the housing market. As we've been saying for a while, activity in this year's market will be driven by lifestyle choices and events such as diplomas, diapers, divorce, downsizing, and death. These life happens events that we call the 5Ds of home buying will continue to drive sales, as they always have.
So then what's our bottom line here? A cooling labor market has prompted the Fed to cut rates, and they've signaled that there's more to come. But with inflation trending in the wrong direction, the long end of the yield curve may remain elevated. Financial markets are already pricing in 3 rate cuts by year end, suggesting limited room for further declines unless incoming data shows sharper labor market deterioration or a more pronounced slowdown in inflation.
But can the FOMC, get it, the FOMC us through? Can they see us through the real estate doldrums?
Very clever. Very clever.
We can't count on lower mortgage rates, but housing activity should improve anyway. Applications are up, inventory is growing, and builder sentiment is stabilizing because life happens regardless. For commercial real estate, lower short-term rates help floating rate borrowers right away, even if valuations take longer to recover. But one last thing, Odeta, when it comes to mortgage rates, we are still waiting for a, quote, mortgage rate star to fall. No?
Gosh, there it is.
I told you I would get another reference in, and for those who aren't aware, that is a 1988 boy meets girl hit. Listeners, you have to look up this video. This 80s videos, all that synthesizer, the big hair, and even a Polaroid camera. You do know what that is, right? Polaroid camera?
I think I might have seen one in a meme or a museum recently.
Probably, yes.
And before it gets any worse from here, I think we're going to wrap up on that synthesizer note. Thank you all for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the episode, you can follow us on X. It's at Odeta Kushi for me and at mflemingecon for Mark. Until next time.